Welcome to the Corlin Economics Report, a weekly look at financial and political topics relating to asset-based investing. Guests on this program pay no fees to appear, and guests and hosts disclose any equity interest in companies profiled. Now, the Corlin Economics Report.
Hey everyone, welcome to the weekend edition of the KE Report. Corey and Chad here, your hosts for this weekend's edition. On this weekend show, we're going to be very much focusing on investing in the resource sector, especially in the first half of the show, as we're chatting with a well-known fund manager that will break down more of his fund's performance and some of the key stories that have caught investors' interest throughout the at least early part of this year. Back half of the show, we'll touch a little bit on markets, but also cycle, of course, back around to the resource sector. Just as a reminder, please go back through our website, kereport.com, or podcast. Just search the KE Report in your podcast player to listen to all our daily editorials covering some wild market moves this week, especially in the AI space on the back of that DeepSeek news, as well as recapping Fed meeting and a lot of tech earnings, as well as company updates. It was another busy week for all of us. And hey, I thank you all for listening, taking some time on your weekend to listen to the weekend show. To kick off the show, we are chatting with Matt Geiger, managing partner at MJG Capital. If you want to learn more about Matt's fund and follow along with his shareholder letters, just click the link in the show notes. Matt, let's just first recap 2024 in terms of the MJG Capital's portfolio, your fund. What was the performance like last year?
Well, Happy New Year's, guys, if it's not too late to say that. Good to be with you. Look, I would characterize 2024 as an incredibly frustrating year, really across the board for mining investors. I'd say the year was defined by very strong price performance, at least by the two key bellwether metals, which I would say are copper and gold. Gold ended up the year 27%. Sterling performance, best that we've seen since 2010 in terms of annualized performance for gold. Copper, though, did fade pretty hard into year end, still ended 2024 up 8%. And for large portions of the year, pricing was extremely strong. I mean, we saw an all-time high reach for copper around $5.20 a pound. That was in the spring. Even as recently as early October, we saw copper prices at $4.60, $4.70 per pound. So two key metals did really well. The mining equities, on the other hand, really struggled to keep pace, let alone provide leverage to these two key metals. The biggest producers, especially on the precious metal front, did start to perk up, late spring and into the summer, but really at best we're keeping pace with the move that we saw in the gold price. And the juniors, which really is the sandbox in which the MJG partnership plays, were basically neglected for at least the first 9 months of the year. We did have a period, though, starting in late September, lasting through the fourth week of October. So we'll say a 4 or 5 week period, where it really did look like the juniors were breaking out and finally responding to these metal price moves, as well as the somewhat muted but still distinct price moves amongst the larger producers. The fund was up maybe low double digits, low teens, kind of the mid to late October timeframe, before really moving over that 4 to 5 week period. Come that fourth week of October, we were up over 30% year to date. And it was really getting exciting. This was, it was looking like the breakout that we'd been waiting many months to see. But then, of course, it turned on its head, basically to the day when Newmont came out with its disastrous earnings report. That was Thursday, October 24th. That day is embedded in my memory. And then that was followed on about a week and a half later by Trump's reelection to his second term, and the resulting strength in the U.S. dollar, as well as, I'd argue tariff concerns and how that would affect China, which as we know is a major consumer of basically all commodities across the board. And that led to what I would describe as Chinese water torture over the final 2 months of the year, November and December, just watching the portfolio draw down day by day. And we went from that, up over 30% year to date, finished the year up, 6.8%. So it was really frustrating, and that price action was seen really across the whole mining complex. I note this in the latest MJG investor letter, but we saw the GDX drop from its late October high. It was up 43% year to date into that fourth week of October. It ended the year up 9%. The GDXJ was doing even better in that late October timeframe, up 47% year to date, ended the year up 13%. The COPEX, which is an ETF comprised of the world's largest copper producers, earlier in October, but in that October timeframe, was up as much as 30% year to date, ended up the year just positive at plus 2% year to date. So there really was pain across the board, from the largest of the producers to the smallest of the junior explorers. I would just make one final point. If I had gazed into a crystal ball right at the start of 2024, and I'd seen clearly that A, the price of gold would have its best annual performance since 2010, and B, we would see a flurry of mining M&A to the extent that we did, not seen in over a decade. Were those two things to play out simultaneously as they did in 2024, I would have thought that the MJG portfolio would be up closer to 113%, which is the return we posted in 2020. So the fact that we had a lackluster single-digit return on the year was frustrating and in some ways puzzling as well.
Well, Matt, just thinking about that, when you look at most financial institutions, they report quarterly numbers and annual numbers, and it's natural to look at, okay, January 1st to December 31st, how did a fund do? But the reality is most people, when they're buying and selling stocks or ETFs or any equities, are not doing it on the very beginning of the year and selling at the end of the year. So those periods of time, like the September, October rush, or copper stocks mid-year, or some of the periods of time where the gold and silver stocks did run, I think there was periods of a whipsaw motion, but a lot of people that are listening to this, probably had the same experience, where there was periods of time where they had some good trades, or maybe they rang the register on some good trades, but the end of the year, entering on a down note, entering with a whimper from November, December, is really what took the steam and the sentiment down in the sector. As a fund manager, do you look at that as far as when to exit positions, or when to trim positions, when to add to positions? Because those are not done at the beginning of the year or at the end of the year. Those are done during the year.
You make a great point. No, I don't. Many fund managers do, and I am sympathetic to them. But I've structured the MJG fund in a way where all investors, and it's an open-ended fund, so new investors are joining, but from the date of first investment, all investors commit to a 10-year lockup. So while it's more difficult to raise money that way, naturally, I've structured it in a way where I can think over longer time frames, and I'm not beholden to quarterly or even annual results. And I think that type of thinking is certainly detrimental to long-term investment returns. I understand why, if you could see redemptions on a minute's notice, that would be something that's factoring into your decision making. But I've structured this in a way where that's simply not. But your point is still well taken. Like, if the year had ended at the end of October, this would be a very different call summarizing the year's result. And it's hard not to get a little carried away. I was really looking forward in that late October timeframe to reporting strong results to our patient limited partners, raising some significant money off the back of that. But yeah, that simply did not come to pass. And I would put Newmont and Mr. Trump kind of as the two culprits for that real slide we saw in the final 60 days of the year.
Matt, let's talk about that comment you made where in past years, past cycles, you would have expected the fund to be up well over 100% and show that leverage to the metal's price. The problem being, we've heard this argument, I feel like, for a number of years now. And you even look at something like the GDX, which continues to put in arguably lower highs as gold continues to spike to higher and higher levels. It's just not following that same playbook. And this has been over a decade long now. Do we need to understand that maybe this market has shifted and the stocks broadly don't have that kind of leverage, which is why it's so important to be, I guess, a stock picker? Or if you really do like simply the gold narrative, stick to investing in gold and not necessarily the gold stocks?
Well, I still hold the belief that over periods of sustained outperformance in the gold price, or really in any metal price, that the producers and the developers and ultimately the explorers of said metal will provide leverage to said price move. It could be different this time. It could be. I do not think that's the case. Another potential explanation here is that there's some major catch up to be done across the gold space generally. That's the camp that I fall into. It's obviously this dislocation that we've seen is wider than perhaps ever, but certainly in our investment lifetimes, between, at least if you look at the gold space, the price of the physical metal and the mining equities themselves. I view that as an opportunity. So first option is it's different this time. Second is that there's major catch up to be played. I guess the third potential outcome is that mining equities or the precious metal equities are sniffing out a decline in the gold price. And maybe a year from now, we see gold at, 1,800 an ounce. I think that's quite unlikely as well. So I'm firmly in the second camp. I think the third camp is maybe, is a possibility. I think it being different this time and for gold to just continue to run with the metal prices not playing catch up is the least likely of those three scenarios outlined.
Well, Matt, let's dive into some of the ways that you analyze companies when you are the chief stock picker for the MJG Capital Fund. I know that you like to get into stocks early when you appreciate their management team, the project. There's a lot of factors you look at besides just the price action of the underlying commodity. In fact, you've mentioned on our show, that's often one of the last things you look at. But the other thing is when you're getting into these, you're often entering through a private placement. And you have just summarized to your audience a lot of these different things that you look for that are red flags and yellow flags in private placements. For those that like to access the markets that way and get into some of these, what can you tell us are some of the big things that you try to avoid in these, or maybe the red flags that you try to steer clear of?
Well, that's right. And I included a piece in the latest MJG investor letter, discussing this very point. I went back and counted, and we've participated in over 90 different private placements since the fund's inception. So this is certainly a means of initiating a position that I'm quite comfortable with. And of the current 17 holdings within the portfolio, 11 of them were at least initiated through a private placement. And then in many cases, there was open market buying, after that. But I did create this list of 15 different, I would describe as yellow flags for investors to look out for when evaluating whether to participate in a given placement. I will say I took great pains to emphasize that before you even look at these 15 points, you need to make sure the investment checks the same boxes that you would look for as if you're buying the company on the open market. So there's not a huge difference in terms of what you need to see. And you mentioned a few of those: the people, the project, a serviceable financial structure, upcoming catalysts to drive value with the company well financed to achieve those catalysts, a price that is below either expected or fair value, depending on the stage of the company, and an investable commodity and jurisdiction that both make sense on an absolute basis, but also within the context of your existing portfolio. So you always want to start there. And I think it's easy, and I made this mistake earlier in my career, to get tempted by private placements that had incredibly rich terms from an investment perspective. The full 5-year placement with no accelerator is kind of the gold standard for the best that you could expect to receive as an investor. But if the company does not check these 7 boxes that I've just run through, then even the greatest terms, it's not worthy of participation. With that said, even in investments where those boxes are checked, I highlighted 15 different circumstances that should cause investors pause, if not outright rejection of a given private placement. And these 15 circumstances fall into one of 4 different categories. One is the other participants that are taking place in the deal, whether that's board and management, whether that's major existing shareholders, and whether that's new shareholders, which ideally aren't either warrant clippers or engaging in a check swap with the company. Second category is pricing, kind of how the deal is priced relative to past private placements, how it's priced relative to the most recent option grant, and how it's priced relative to recent promotion done by the company. So pricing is that second category. The third is the timing of the deal, including its proximity to previous private placements, its timing in relation to escrow periods lifting, its timing relative to the expiration of in the money warrants, and also timing relative to expected share price catalysts. And then the final bucket is kind of use of proceeds. Where are the proceeds of the financing going to be spent? And so that's how I break it down. I don't think we need to go through each of them one by one, but I would also state that, I did a write-up roughly a year ago that was in the January 2024 investor letter about 25 red flags to avoid for management teams, basically 25 deal breakers that should cause one to look elsewhere when evaluating a management team. I would argue that the vast majority of these, while they should cause an investor to be extremely wary, there is room for some nuance. So important to keep in mind, but in the case of a CEO with double-digit ownership and the vast majority of his or her net worth already invested in a company, it may be okay to participate in a deal, even if that CEO is not taking a piece for themselves. Or in the case of a financing where there's, the expiration of deeply in the money warrants, within the next 4 months, if the number of warrants is, utterly inconsequential relative to the company's total share count and average trading volume, perhaps that can be overlooked. Or, one of the circumstances mentioned is a keep the lights on financing, to avoid financings where the company isn't raising enough capital to answer at least one significant unanswered question. In the case where the company is an optionality play, which is not a typical investment for the MJG partnership, but just as an example of an edge case, where the whole premise of the optionality business model is to in essence, do nothing other than keeping the lights on, that can be overlooked. So I want to emphasize that nuance can be applied to these points, and very few of them are flat out deal breakers in their own right.
Matt, I want to put a situation in front of you too when it comes to a financing. A company that, let's say the share price has done fairly well, it seems to have stabilized at a generally, let's say, higher level. And then they issue a news release that says they're raising money at a discount to market, a fairly significant discount to market with a warrant. You see the stock price drop right when that news comes out to that financing price. How do you evaluate those type of financings when they are done at a discount to market when the share price seems like it had stabilized higher?
I think one question you should ask before we get into this hypothetical is, why did the share price re-rate in the first place? And if the share price re-rated off of the back of heavy promotion and no fundamental company-specific catalyst to actually justify the move, one should be a lot more skeptical about the raise, irrespective of how big the discount is or what the terms are on the deal. In your hypothetical, assuming that the share price move was justified by a real catalyst, maybe it was a drill program, maybe it was an update to a resource, maybe it was a PE or a significant permitting milestone, then I'd be more receptive to participating in said deal. And then the other question I'd ask is, well, is the company raising at this discount and with the warrant because they don't have access to capital at the 50-cent level? Or is it a sweetheart round for insiders and for existing shareholders? So I think that should also be questioned. And of course, all deals are different, all have specific circumstances. So if I were looking at this, I would see who's participating. And in many cases, when there's a sweetheart deal, there's not room for outsiders to come in. And that kind of makes your decision right there on whether you want to participate or not. If you own common shares of the company and see a sweetheart deal where a company is raising at a discount with a warrant that seems unjustified or overly generous to new investors at the current share price, then one should certainly re-examine their decision to hold that company to begin with. So I think there's so many different variables. I don't know if you want to flesh out that hypothetical anymore, but those are a few of the thoughts that immediately come to mind.
Well, Matt, you mentioned there was 15 yellow flags, but off mic, you mentioned there was definitely 2 red flags that would cause you to say a hard stop, probably not interested. Maybe just cover those since those are easier for people to digest, get their head around.
Sure. Well, yeah, the 2 big ones would be a financing being conducted less than 4 months after the close of a previous financing, particularly if that financing is at a premium to the previous financing, particularly if it includes worse warrant terms. But really, in any circumstance, even with really sticky investors, you're going to see a decent amount of selling pressure when that 4-month and 1-day hold period lifts. And this pertains to Canadian markets, not the Aussie markets, to be clear. But you're putting yourself in a position to be exploited, in essence, by the participants in the previous placement if you're putting money into a deal that is priced before that 4-month and 1-day hold period lifts. So if you're in that position, even if it's a financing that you are excited about, you really like the team, the project, the company structure, I would stress to management, let's hold off for this 4-month and 1-day period to pass. Let's see where the share price settles. And then at that point, I'd be happy to participate. And if they're unwilling to do that and they plow forward with doing the financing otherwise, then perhaps it's best to look elsewhere. So that's one clear example. The second one is also very important. And this is when you see a financing that is conducted just before a significant share price catalyst is expected, a share price catalyst that the company is already sufficiently funded for. So, such a catalyst could be a significant drill program at the company's flagship project. It could be an updated resource or a maiden resource. It could be a key permitting outcome. It could be a PEA, the first look at the project's economics, a whole host of different catalysts. In the hypothetical, said company is coming out with one of these catalysts in mid-2025, say June 2025, and they're well cashed up to achieve that catalyst. But 30 days or so before said catalyst is expected, the company comes out and says, we're raising a boatload of money. That should say clearly to you as an investor that bad news is in the offing. Otherwise, if this management team was acting in the best interests of shareholders and they had good news to report to the market, in just 3, 4, 5 weeks away, they of course would hold off on doing the deal, wait to announce that news, and then raise on the back of the share price re-rate that one would expect to see on the back of that news. So I think it's important to, when you're evaluating a placement, look at it in the context of stated catalyst that the company had said previously. And if it's occurring, when there's a catalyst in the very near future, that's a clear sign that there is bad news that is coming down the pike.
All good points there, Matt. And you know what? For those that can get into private placements, that's your chance to really talk to management and hash out a lot of these details. Plus, a lot of the shareholders and stuff you can find online too, diving into especially that CDAR website. Let's talk a couple stocks that have been getting some attention. One that you're bringing to our attention is Koryx Copper. This is traded KRY on the TSX Venture Exchange. The company's project is in Namibia. Look, this project has a lot of history behind it. Major companies have been on this project, including Rio Tinto, Teck. There is a current resource, maybe a bit of a lower grade resource, I think right around 0.35% copper. But this year the company has a big drill program planned, I believe right around 55,000 meters. They're going after it hard. Right now, this market cap of the company, right around $80 million Canadian. Break down how you view Koryx Copper, the good and the bad here, Matt.
Be happy to. Koryx was the featured investment in the latest MJG investor letter. I did a good 12 or 13-page write-up on the company. For anybody interested in reading through that, it's on the MJG website at mjgcapital.com. And Koryx is also our most recently initiated position. That was all the way back in June 2024. So if you can believe it, it's been 7 months since we've added a new name to the portfolio, and Koryx was that name. Look, I think it's a pretty simple investment to understand. The thing that attracted me to the story, really full stop, was the people involved. It's Haya and his partner, Alan Friedman. These are two gentlemen that have had multiple successes in Namibia, which is where Koryx's flagship Habe copper project is located. And just in the past 12 years, they've sold 2 different companies for a total of 550 odd million Canadian, one to a Western buyer, one to a Chinese buyer. And of course, the most recent one was Osino, which saw that deal close just in Q3 of 2024. I think it was less than 3 trading days later, Haya was formally introduced to the Koryx story as the executive chairman. And, this team has a history of taking later stage projects and optimizing the engineering, pushing through permitting, getting them to a point where they're ready to be built, and then selling them on to larger parties to take the project forward. And they're looking to repeat that blueprint right here with Koryx. As you mentioned, it's a project that's already seen significant amount of work over many decades, starting in the 1970s. So they have a huge amount of drilling data and previous engineering work to piggyback off of. And they have a very ambitious timeline. Their goal is to get this thing fully permitted and get a feasibility study out in late 2026. They just raised a significant sum of capital at $1.10 Canadian with no warrants. So that speaks to the access to capital that this group has. They'll probably need to do one more financing before they can get through that feasibility study, but they're really off to the races between drilling, metallurgical work. We'll see potentially 2 different economic studies announced this year, followed by a feasibility study in late 2026. And the real thesis here is simple. You note the deposit has a low grade, 0.35% copper. That number's likely to rise closer to 0.42% copper equivalent once moly and gold byproducts are reflected in the resource grade. But even for an open pit project, it's definitely not a high grade deposit by any means, but it has a whole lot more going for it. Despite being already very advanced, it's close to infrastructure, power, roads, very importantly, water. It's located at a low altitude. There's not going to be difficulty bringing in labor. This is not a fly-in, fly-out situation by any means. So they can push this forward quickly and relatively efficiently, particularly compared to, say, a project in the high Andes or, deep in the Democratic Republic of Congo. As mentioned, it's a jurisdiction that they know well, a mining ministry that they've worked with very closely for many years. They think a permit can be in hand by the end of 2026. And their goal here is to prove to the market and to address the skepticism that this project is too low of grade to make sense at current metal prices. Haya is convinced, and his team is convinced, that HABE can work, in the current copper price environment, say $4 to $4.50 per pound copper. Obviously, if copper runs to $6 or $8 per pound, that would be gravy. But that's not the MJG investment style by any means. Though I should note that due to the size and the relatively low grade of this deposit, you'd see pretty exceptional leverage for a project of the type of HABE. But nonetheless, Haya is convinced that it works at current metal prices, and he will look to prove that over the course of the upcoming updated PEA, pre-fees, and feasibility study in late 2026, at which point the company would likely seriously consider selling it to a larger producer to take forward. And Namibia is friendly to both Western and Chinese interests, most recently evidenced by Osino's sale to Shenzhen Gold out of China. So I think if the team can execute on its goals, and past history suggests that they do execute on their goals, they can get into a position within 24 months here to monetize it at a significant premium to the current share price. And I'll just end quickly. If you look at multiples paid in major copper transactions dating back to 2021, even if you take the very lowest PNAV multiple at which a transaction was taken place, I would argue that there's potential for 3x upside from the current share price, even factoring in the additional dilution that will be needed to take this through feasibility. So I think even though the share price has admittedly re-rated pretty sharply since the involvement of this Sino team, I think there's plenty of meat left on the bone for investors that believe in this group executing.
Well, Matt, I appreciate you breaking down the value proposition that you see in Koryx Copper. And yeah, a pretty infamous team, especially when we were all at Beaver Creek. That was the talk of the town because they had just sold Osino and were just shifting into Koryx Copper. And while we're talking about copper and gold, the talk of the town at the Metals Investor Forum and the Vancouver Resource Investment Conference that we just attended in Vancouver was Amarc Resources, another copper and gold stock that's gotten people's attention. Wanted to get you to weigh in on it. At the current place, it's still early days, and this is a JV that Amarc has with Freeport, the large major metals producer, and they had some pretty exciting copper gold results that hit the market. It's really gotten people's fascination. So again, this is the talk of the town at the latest conference season. What's your take on the results that we've seen come out of Amarc Resources?
Sure. I mean, it's definitely captured the attention of the junior mining space. We have no financial interest one way or another in this discovery. I do think it's very exciting. I mean, it's rare to see widths at those grades, particularly very near surface. A lot of these intercepts that we've seen are starting less than 100 meters below surface. So I think the excitement is justified. As you mentioned, this has already been relatively well covered by other parties, but kind of a few points that come to mind for me. The first, I would say, this is more of a gold discovery than anything. Amarc is certainly taking pains to brand it as a copper discovery, but if you look at the intercepts, really a good 25 to 35% of the value is copper, with the rest being gold. So we can say 70% of the metal value appears to be gold. Perhaps Amarc is playing to the market, thinking that the market would more embrace a brand new copper discovery in BC versus gold, or perhaps they're catering to their partner Freeport, who clearly is more copper focused than anything. So that's one point I would note. A second is, the interesting dynamics in terms of Freeport's decision making going forward here. Interesting deal in that Freeport has the option to earn a 60% stake in the project by spending $35 million. And then the option to take that up to 70% interest, an additional 10% project level interest, for a full $75 million. So really big sums here at play. Freeport, to my understanding, has already spent $34 million. So they are $1 million away from a decision point where they can choose to either spend $75 million over the next 5 years to get to that 70% stake, or if they want to squeeze Amarc, could turn it immediately into a 60-40 contributing JV. My expectation is that they will go for the 70%. For these bigger parties, it often behooves them to play nice with minority partners so that they can do deals with other groups in the future. But there's at least one astute observer within my network who thinks there's a chance that Freeport might convert this to a 60-40 JV when they hit that 35 million mark, in the next few months here. So that's an interesting dynamic to watch. And then the other angle, of course, is TDG Gold, which is right next door. I'm naturally skeptical of area plays, particularly in the Golden Triangle, where it's a huge country up there, and having a neighboring project can mean absolutely nothing when you're talking about tens or hundreds of kilometers. But in the case of TDG, this seems to be real. I mean, the discovery hole was a few hundred meters from the property boundary. And while it's yet to be proven, it does seem reasonable to suppose that this, tabular ore body, which, trends from the east to the west and has been defined to date over 600 meters, is likely to trend onto TDG's property. TDG has done drilling near the property boundary, but the depth of those drill holes were only 200 to 225 meters of depth, and based on the geometry, it's looking like if the ore body does extend onto the project, that we'd expect to see it at the 400 to 500 meter depth level. So that's an exciting target for them to test. I think the share price re-rate, TDG has actually done better than Amarc on the back of this discovery from a share price perspective. I think that's well justified, and that's going to be an exciting story to follow going forward. Though, as a word of caution for everybody that's excited about Amarc and TDG, I should note that there is reason to be skeptical of whether this is large enough to be of interest to Freeport. Excellent grades, nice widths of 180 meters, but it does seem like the mineralization drops off almost entirely once you're through that tabular ore body. And I think it would be a lot more interesting if the mineralization continued, even at much lower grades, so that you could get more of a bulk tonnage scenario with a higher grade zone closer to surface. That may be the case. It doesn't seem like we're seeing that yet. And so there is risk that Freeport, goes ahead with their phase 2 of the earn-in, spending $75 million to go up to 70%, spends 10, 15, 20 million over the next couple years, and kind of comes to the decision internally that this is not Freeport size, or this doesn't fit in with our company priorities strategically. And it's a long wait. I mean, once the clock starts on that phase 2 earn-in, let's just assume it starts mid-2025, that takes us all the way to mid-2030 before they have to make a decision. Freeport could play nice, and if they decide it's not big enough for them, maybe they could vend their project level interest into Amarc in exchange for shares and let Amarc run with it going forward. But there is risk that Freeport spends another year or two, aggressively pursuing this and then, hesitates on whether it's big enough. That would leave Amarc in a lurch. TDG owns their project 100%, so they can continue to push forward, but that could delay any ultimate consolidation of the district, longer than folks maybe would hope. So those are all thoughts pinging around my head in terms of this discovery. But certainly exciting, certainly good news for the space.
Absolutely. We saw the share price react, and we also saw some other companies, as you said, in the area. Still early stage, but I'm glad you did touch on that area, that Tutagon area, because it has come back into light right beside the Golden Triangle. We'll see if more activity happens there, because it has been relatively active over the last few years. All right, Matt, we're wrapping it up here. So again, Matt Geiger, managing partner at MJG Capital. Make sure you click that link in the show notes to learn more about Matt's fund and MJG Capital broadly. Matt, thank you so much for taking time with us on this weekend show. Everyone stick around. We are going to be right back.
Al Corlin's firm, A.B. Corlin and Associates Incorporated, provides consulting services to public companies on matters of regulatory compliance. To find out more, follow the link from www.kereport.com. The Corlin Economics Report will be back after this brief timeout.
All right, welcome back. Continuing to listen to the weekend edition of the KE Report. And in these final two segments, going to focus a little bit more on the key stories from this week, including news out of the AI sector, DeepSeek. Boy, oh boy, a lot of news around that. How the markets reacted. We'll even touch on some of Trump's tariff, or at least the news around that. Fed, other central banks, and markets that are continuing to do well, individual sectors. Chatting right now with Mike Larson, editor-in-chief at Money Show. Mike, I think we have to start off with the DeepSeek news. We talked a fair bit about it during the week, and Monday, well, a few sectors within the AI sector got hit. The chip makers and the energy sector, both of those got hit the most. Big tech was pretty resilient through it all. But look, the big news being DeepSeek might have come up with an AI model that uses less expensive chips, less energy. Seemed like it could be maybe a turning point for that whole AI trade in terms of efficiency and cost reductions. Maybe just a growing up of that trade too. Mike, let's start off with how you take the action from this week all around AI and the DeepSeek news.
Yeah, it's such an interesting story. I mean, I don't pretend to be a tech expert that knows all the intricacies of how these models work and this, that, and the other, but I can surely watch the markets and see how they respond. And it was wild news to say that, we did for $6 million what other companies are spending hundreds of millions of dollars to do. And then, the various parts of the sort of tech apparatus and even the government come firing back and saying, yeah, well, they probably actually did spend a lot more than that. They're full of it. And by the way, they might have been stealing our stuff to come up with their model anyway. So it's a really interesting story to see how it all sorts out, how much is true, how much is fiction, and so on. But what stands out to me is just, regardless of whether it's 100% true or not, the market surely treated it at first like it was before kind of settling down. So, I don't want to go as far as say this is a canary in a coal mine, this is the needle that pricks the AI bubble, blah, blah, blah. I don't necessarily think that's the case. But what I think is important to know is that as strong as tech has generally been for quite some time, and AI stocks have certainly been the standout performers, what's actually noteworthy is we've seen a shift behind the scenes, kind of a sneaky shift, I call it, in terms of what groups are outperforming and what's doing the best. And it's not tech anymore. It's kind of funny, but if you look, last year, you look at the first half of 2024, something like the IWM, the small cap ETF, was up like 1% when the Qs, obviously heavily into tech, were up about 20%. But if you measure, starting in July of last year, we saw kind of a seismic shift where that was one of those weird months where tech tanked and small caps took off. And we kind of tried to retrace some of it. But in the 7 months since then, if you measure market performance from July 1st, 24 through basically this week, small caps are beating tech by 5 percentage points or so if you use the QQQs. And if you look at something like the XLK, the tech ETF, the sector ETF for the S&P, and you compare that to pretty much anything, industrials, financials, real estate, materials, and on and on. The XLK is going nowhere where all these other sectors are putting up gobs of points. So what's interesting to me is putting this move in all this volatility in tech into context. And when you do that, you come to the conclusion that sneakily behind the scenes, tech has actually been losing its outperformance luster, and you're making more money in other sectors for the first time in a long time. And not just other sectors, other like market cap groups, small caps versus mega caps, and so on. So I think that's the bigger story. This Chinese stuff will get a lot of press. DeepSeek will get a lot of press because it's sort of an exciting, sexy story. But if you're like me and your goal is to make as much money in the markets as possible, pay attention to the longer term trend that's going on there, because that's where I think there's some clues as to what's going to happen as the year plays out.
Yeah, such a great point, Mike, that we've seen for really months, like you say, 6 to 7 months, outperformance in other sectors over tech, and even, like you say, subsectors, the small caps and the mid caps, making up the ground on the mega caps. So that is the bigger trend, and we saw that in spades on Monday as well, where most of the markets were just fine, in fact, rallying, and most sectors were just fine. But just circling back to the news that hit from DeepSeek, the other area that really was hit besides AI and chips, obviously NVIDIA and Oracle and the semiconductors ETF were hit hard, but energy was affected. There is the largest utility, Constellation Energy, that dropped by over 20%. The small modular reactor stocks, the nuclear stocks that were set to power the AI revolution, dropped by over 25% apiece, 3 different stocks. So it was kind of some carnage that spilled over into uranium as well. But a lot of people have digested the news over the balance of the week and said, well, wait a minute, we're still going to need a lot of energy. We're still going to need a lot of these developments. So do you think it's one of those situations where it was an overreaction and now people are starting to think longer term?
Yeah, I mean, look, it's funny because some utilities behaved like tech stocks because they were latching onto the AI trade, right? I mean, you laid out the process. We're going to need a lot of computing power. We're going to need a lot of data centers to put that computing power in. We're going to need a lot of power to make sure those data centers have electricity. And by the way, we're going to have to burn more gas or build more nuclear reactors to feed the reactors that feed the electricity to the data centers that process or that have the computers that process the AI tech. So it's this whole daisy chain of sectors that are all kind of tied to the same underlying trade. So naturally, when everything goes up on one trade, everything's going to go down when that daisy chain is reevaluated. But I think all in all, I mean, again, this is probably just a case of taking some of the steam out of the market, or taking some of the air out of it without completely deflating it or popping it or whatever. But again, as exciting and future forward as the AI trade is and the story is, I would just counsel investors, and I've done this and I've said it on your show and I've said it in person talking to people and I've said it in my columns. Remember, this 2 years ago, even up, until last year, parts of last year, this was a market where, looking elsewhere didn't reward you. You're kind of wasting your time. You could buy a handful of stocks and make a lot of money, and, that was all you had to do. But that's not the case anymore. So you're actually, whereas before being lazy and just looking at a handful of stocks and only focusing on the tech sector rewarded you, that's not happening. That's not the case anymore, and it hasn't been for quite some time. And, I don't think that's a flash in the pan. I think it was a seminal moment for markets from a big picture, long-term trend, what happened in July of 2024. I think when we look back at market history and say, that wasn't just, a flash in the pan where tech got crushed and small caps took off and the outperformance, kind of radically shifted. I think that was the start of something that's going to be a multi-year trend, or at least through this year and probably next year. So, me personally, I'm looking at these other sectors. Some of the speakers at our events are talking about these other sectors. Ed Yardeni's been all over the financials, for example. My own work kind of in the real estate space suggests that that's a nice turnaround setting up there, the REIT sector and so on, after just a long period of time where it didn't do anything for you, it actually hurt you. So and materials and things like gold. I know we'll talk about that in a bit, miners and so on, opportunities there. So I just say broaden your horizons. Tech is great. I don't think tech's going to crash. This isn't, .com 2 or anything like that. We already had that back in 2021 and 2022. This is more a situation where I don't think tech hurts you a lot, but it's not going to give you the kind of performance bump that it had done for so long relative to many other parts of the market.
Okay, so still a lot of different opportunities there, some that you laid out. What about, though, just simply still some people, again, that passive investing strategy of just putting your money in the markets. As much as we saw a shock to some sectors on Monday, look, the S&P is still pretty much at all-time highs. So is there still opportunity, even if you might underperform some other sectors or individual stocks, that the market still looks relatively stable to you? Or are you in that camp where people say it's gotten too extended? Look at how far away the S&P is from some key moving averages, that it needs a much larger or longer term correction.
Look, I wouldn't be surprised if this first quarter has more volatility than we've seen in a while. I mean, even, in sort of the obviously this week alone in tech, you've seen what can happen with stocks like Nvidia and the market overall. But I think that, again, the underlying forces that are driving this, some which are sort of political, economic, less regulation and so on, friendlier tax policy, some of which are monetary policy arena, the Fed basically moving to the sidelines. They're not really cutting. They'll probably cut, in my opinion, maybe one or two times later in this year. But, they're certainly not going to resume hiking, in my opinion. So the Fed has kind of gone from being, in 22, a very unfriendly factor, and part of last year, a friendly factor, now being kind of a non-factor. And you throw in decent economic growth and policy that's going to favor domestic and growth over international and so on. And there's still reasons to expect a pretty solid year for the markets overall. You can always make a valuation case there, and I pay attention to valuations, but I need to see a catalyst of something that's going to sort of change the narrative in conjunction with valuation. I don't think markets just sort of collapse on valuation alone. So if my sort of analysis or the way I see the economic and monetary policy and other forces, fiscal policy, unless something kind of changes there, I'm still fairly optimistic for the year. I mean, I don't think, I certainly don't expect another 20% plus year for the S&P. That'd be kind of wild, but solid single digits, put me in that camp.
Well, Mike, when you think about the macroeconomic picture, you look at GDP growth, it's still in the mid twos. You look at inflation, it's not at 5 or 10%, it's not down at 2, but it is in the high twos to low threes, and so it's at a reasonable level. When you look at the job market, the labor markets, they're not falling apart. So I don't really see why the Fed would have any impetus to start cutting like crazy, because the markets are doing fine. Like Corey just mentioned, the S&P is up near all-time highs. We still had people calling for an economic contraction, or they're worried about tariffs, they're worried about the Trump administration, but it seems to be pretty vanilla macroeconomic data.
Yeah, I mean, I think the reason the Fed cuts once or twice is just because, the rate of inflation has come down, and the Fed funds rate is still pretty high above the rate, or not pretty high, I should say somewhat above the rate of inflation. So, rates are arguably a little restrictive in a world where, we've gone from, 6.5%, I think, core inflation at the peak back in the summer of 2022. Now we're at somewhere in the high twos. I mean, it's not 2 where the Fed wants it, but it's been cut in half. It's been more than cut in half. So when inflation's been more than cut in half, at least the way the Fed looks at it, core inflation, why haven't rates been cut in half? I mean, it's a simplistic kind of silly way to look at it, but it illustrates the point that you don't need the same interest rates that you had when inflation was up at 6+%, when inflation's at 2.5 to 3. So I think that's why they're going to gradually normalize rates, and it's not going to be something where they rapidly shift to cut more aggressive cuts unless the economy or the markets fall apart, and that's kind of not what I'm expecting.
So is that what the market's pricing in? How do you see the market positioning when I'm on your page here, Mike, where I think the Fed is actually in a pretty comfortable situation where they can take their time, slowly lower rates to keep up with generally what we're seeing in terms of better economics, and who knows, maybe not goose the markets as much as some people might want them to, but also be able to bring down their rates. Where are the markets positioned right now?
Yeah, while you were asking your question, I was popping over to the CME to look at the most recent FedWatch numbers. I mean, they're not perfect, but they give you a pretty good idea. And right now, the market's pricing it. The highest chance, and these, again, when I say highest chance, it's still only 46%, give or take, which is not extremely high, so that doesn't guarantee it'll happen, but is that the Fed will cut at a 25 at its June meeting, and then the next highest probability cut all the way down at like 33% is December. So the markets are pricing in, arguably 2 25 basis point cuts, one at mid-year, one at year-end. But, you know how this stuff works. All the forecasts get kind of squishier the further out in time you go because things can change. But that doesn't really argue, that's kind of where I was anyway, even before the Fed paused this week and even before the markets kind of priced in. I don't see the Fed being aggressive. I don't see the Fed being an obstacle for the markets. in that situation, as long as growth is okay, earnings are coming in, the Trump stuff turns out to be more bluster than actual action, which, let's be honest, I mean, if that was a lot of what we saw in Trump 1.0 was, this is Trump will say almost anything. What he'll actually end up doing, if people kind of bend to his will or where he wants them to go, that's another thing entirely. So, and I think the market's kind of sensitive. That's why, late when I know we're recording this here on Friday, was yesterday, I think the market, as soon as there was that 25% tariff headline on Mexico and Canada, everything dropped, to negative territory. And then probably 5 minutes later, we gained a lot of that ground back because people are kind of realizing. And sure enough, here's the headline that now it's going to be more like March 1st. What's talk and what's action are two different things.
Yeah, it's a great point, Mike. A lot of bark. We don't know how much bite there's actually going to be, what actual policies get implemented. Do you think there's anything that the Trump administration or that the Fed could do that would be a wild card here? Is there anything that could happen on the geopolitical stage or nations trading with other nations or on the currency front that could upend the apple cart?
Again, the geopolitics stuff, how much pushback you get from some of these trading partners to what Trump says or does, those kinds of things are wild cards. And, just like I said, if you go back to Trump 1.0, I mean, how many times did we rally 300 points in the Dow because some headline said U.S.-China trade deal reached? And then how many days later did you have U.S.-China deal off and we lost 300 points? I mean, I think overall volatility, if I can say anything about the whole Trump impact on markets, is that volatility is going to remain more elevated than it would all else being equal. So, and that means to both directions. I think like the VIX actually ends up sort of staying in a slightly higher range in Trump 2.0 just to price in the potential Trump effect, So that, but at the same time, I don't think that means you're going to see VIX 25 or 30 or something. You're just going to be maybe in the mid to high teens versus the low to mid teens. And you're going to have those spikes and those days where, you might have a lousy day because some headline comes out of somewhere. But all in all, it doesn't derail the overall trend.
All right, Mike, let's move over to commodities then, because look, I think pretty much all commodities were off to a pretty strong start to start the year. Some commodities have slowed some of that momentum, but something like gold, that continues to be very strong. As we are chatting, gold still right around 2850. That is all-time highs. And even the gold stocks, GDX, just this month is up over 16%. That is after a few tough months to close the week, but gold, man, it's just higher, higher, higher. So what do you make of the precious metals trade right now?
Yeah, I mean, gold here, look, it's been a bull market. I've really been in the bull camp going all the way back to 2018. We had that long stretch where it was like waiting for Godot for gold to after the first leg up of the bull market to resume the second leg. But it's clear we're in that now. And I think that this validates, I mean, all the underlying things driving gold, which are basically less interference from the US dollar going up every day, more Trump-driven volatility, more diversification out of bonds into precious metals from not just central banks, but private funds and so on. All of these things ultimately point in the same direction, and that's to higher gold prices. So I think that, this 3,000 in Q1 is kind of where I'm at. My expectation, we hit that 3K number sometime before the first quarter is over, and I think we continue to climb from there. I mean, it's not, and I always say I'm not like a crypto hater. I don't think it's gold or Bitcoin or gold or crypto. I think they're kind of both being driven on some level by some of the same forces, and I just don't see that big macro trend, the forces that are arguably positive for gold to change. So it's been a long time coming. I think we hit that 3K level, kind of reevaluate. I don't know where we're going to finish the year, but underlying forces are there. I think things like silver are probably going to play a little catch up, especially if there's a little more optimism about global growth and growth in the U.S. So you might get a little boost in that sort of industrial side of silver. And as far as the base commodities, again, there's still the China effect, and they're not going to be building a new city every month like they were doing for so long during the real estate bubble. But even there, you're getting some stimulus and some other things that kind of argue for at least China not to be a drag on the market when it comes to things like copper and so on. And copper's got the case as sort of being levered to, the energy transition, which even though Trump is certainly not an EV lover and certainly not a new energy lover or whatever, the world ultimately will go that way over time, regardless of what Trump thinks. So, that underlying trend for copper is probably still there as well.
Well, Mike, you mentioned that you could see $3,000 gold in the cards, and a couple of years ago that might have sounded like a big statement, but we're really pretty close. We're only $150 away from that now. So, what does that mean for the gold equities, and even to a lesser extent the silver equities? You mentioned that you were open to those as a theme this year. It's been a long time coming for the gold stocks to finally outperform gold. Sometimes they've been underperforming it or just keeping parity with it. Do you think this is the kind of year where the gold equities could shine?
Well, I'll tell you, just this week I've seen some nice technical breakouts. I mean, even something like the GDX, the main gold ETF, had a big gap up and a strong finish on Thursday. And I think some of the individual miners are looking better. So yeah, I mean, again, if you have things like inflation kind of easing back, certainly versus what we had a couple of years ago, where one of the big problems for the miners was just the cost of everything. I mean, the cost of drilling, the cost of hiring, the cost of getting from point A to point B and getting your machinery in the field and processing and all that stuff. I mean, there were a lot of cost issues that were hurting them in terms of the dirty business of getting minerals out of the ground. But if that has kind of eased back, which it certainly has from peak levels, then you've got a lot of leverage to the gold price and silver price for that matter. So I think that, I hate making a bad pun, but I think, yes, it is their time to shine in 2025. So, I would still be longer that sector than I would have been a couple of years ago, and I think that is going to pay off for people, because this is definitely, in my opinion, a move that will have durability to it and have a duration to it. It's not just going to be kind of a quick thing that ends soon.
Any comments on time frame then, Mike? Because you made the comment that you have been in the bull gold camp since 2018. That makes about 7 years of a bull run here. You can arguably even say that it has been moving higher ever since the start of 2016. So 8 to 9 years there of where we stand right now. Any historical context of length of time for bull market moves in gold?
I think I would just highlight the fact that this has been sort of a two-phase process, and we had a long breather of 15 months or something, where just, gold and most mining stocks just chopped around sideways in the middle of this bull market. So I'd think it was a lot closer to the end if we never, stopped to gather our breath. And frankly, we stopped to gather our breath for longer than I ever thought possible. So I think that's probably, all else being equal, a thing that leads to this lasting a lot longer. I mean, we did, it wasn't just a one leg up just one leg up that's been strong and never stopped. I mean, throughout the entire length of basically 2021 and 2022, and into 2023, we chopped in all before we started rallying towards the end of 23. So, I'm not so much one of those technicians that looks at charts or point and figure type methodology to say, okay, based on my research, it's going to last 16 and a half months and end at 3,127. I mean, some of that's not my forte. It's more to just sort of be a generalist and take the big picture view, and that's own it, still own it, buy it if you don't. And until I see a real reason to say this is exhausted, or I see a blow off top or something like that, steady as she goes.
Well, Mike, just to tie a lot of these themes together on the macroeconomic front, what the Fed is doing with rates, gold, cryptos, we haven't really dove into the dollar, the greenback. It's had a stronger period of time the last 6 to 8 months than a lot of people were expecting. Trump is a guy that really wants a lower dollar, yet it remains sticky high. That's obviously a headwind to a lot of sectors, headwind to a lot of companies, headwind to the commodities. So how are you looking at the dollar setting up for the balance of the year?
Well, I find it interesting that obviously the dollar started rallying at the end of September, early October, when the polling looked like it was really swinging Trump's way. But then earlier in January, we had that sort of peak, and then we give back some of that, and we look to be stalling out and running out of steam. So I think, kind of funny, I think that, you're at the point where you've priced in a lot of the potential positive impact of tariffs on the dollar. And now you're looking at people saying, well, Trump doesn't really want it to get any stronger, so he's going to find some way to weaken this thing, or at least keep it stable. So I think the lion's share of the dollar move, in my opinion, is over. I wouldn't be surprised if we kind of roll over, or at least just chop sideways to down for the majority of the year from here. So I don't think the dollar is going to be an obstacle for commodities in general, or gold in particular.
All right, there we have it. Mike Larson, editor-in-chief at Money Show. One thing to note is the next Money Show coming up in Las Vegas, February 17th to 19th. I'll post a link in the show notes so all of you can learn more about the money shows and see who's speaking at the event. Always a wide range of speakers, including our good friend Mike Larson. So please go check out that conference if you are in town or just even want a little time in Vegas. Again, Mike, thank you so much for your time. And everyone, thanks for tuning in to this weekend show. We hope you all have a great rest of your weekend, and we'll be back with you on Monday.
Good, guys. Thanks for having me.
The Corlin Economics Report is produced for A.B. Corlin and Associates. Opinions expressed on this program are intended solely for the entertainment of our listeners, do not constitute investment advice, and are not necessarily those of this network, radio station, or our sponsors. Find out more about this program and today's guests by visiting www.kereport.com. For Al Corlin, this is Colleen Robbins. Join us again next week for the Corlin Economics Report.